Welcome back to the ETF Inspector. It's Thursday, January 22nd, a little bit after noon, and this video is going to be a little different than normal. This is not an ETF inspection. It's not a coverage video or an update of specific funds, but this is more of an announcement style video on closures of some ETFs and some halting of filings. So it's got a lot to do with leverage. So we're just going to get right into it. As you can see, the top of the screen have a whole lot of pages prepared. So we're going to just look at what is closing and see if we can see how the performance has been on them, see if these closures make sense. All right, so if you just search for SEC halts leveraged ETFs, right, they've recently halted reviews for proposed ultra leveraged ETFs. So that's going to be ones that are in the 3 to 5 times the daily returns. They've been sending out warning letters, right? We're going to have a couple different pages we'll look at. I'm not going to just sit here and read line by line to you on everything, but some of these came out in December of 2025. But then we've got some updated announcements for January 2026 to look at. So why they stepped in is the excessive leverage. These funds aiming for 3 times and even 5 times daily returns. Up until, so if you remember recently, not that far back, there weren't even allowed 3 times leveraged, so you could only really get 2 times, or the ones that were kind of grandfathered in. And now somehow it was making a comeback, but it looks like it's being halted. Their primary concern is that these funds couldn't pass the value at risk test. It limits risk exposure relative to assets, making them inherently too risky. So they have implosion risk. And so what this impact is, 9 different firms received it says nearly identical letters from the SEC halting review. So you're going to see firms like ProShares and Direction withdrawing their applications for some of their leveraged funds. And then this, for investors, means there's going to have less availability of ultra leveraged products, which, you know, some people are going to say that's a good thing because it protects people from themselves. Others are going to say, hey, I knew the risk going into it. I want the extra risk for the extra return. So, but in any case, this is what we're going to want to talk about. So, just in case you're feeling like, hey, we don't want to believe like the AI overview, Reuters is pretty well known and respected, right? This came out back in early December. So this halting of reviews is not brand new news, right? They mentioned again those 2 companies there, but there was 9 different ones who got the letter. And so just found another article from Eccleston Law speaking in reference to, because it seems like they are a law firm related to investing. So they stepped in to curb the law firm, the SEC, Securities and Exchange Commission, curbing the expansion of these ultra leveraged ETFs. And issuing warning letters to block proposed products designed to deliver these high leveraged investment opportunities. Let's see. So the 9 companies, we've got Direction, ProShares, and Title. You would think that they would have listed all 9 there. I thought I had more info in this letter than expected, so we'll keep on moving. So next we're going to have, I got this from Globe Newswire, Title. You might be familiar with my channel. Title is behind a handful of the different ETF providers. Defiance is the one we're going to be talking about here in this video, but Title is also behind YieldMax as well. Now, I've seen some other people make videos similar to this, and they liked to throw YieldMax into this category just because they pay high yields. And the issue is not about high yields, it's about high leverage. And so it does not make sense to be including YieldMax in this conversation, because YieldMax in their pile of ETFs that they are providing are not using leverage. Mr. Michael Venuto comes out and talks about it fairly often, that he's not a big believer in the leveraged funds, and he even actually has criticized recently in the last few months before any of this started these different funds, not specifically talking about Defiance, but some of the other competitors that you hear a lot that are specifically just a leveraged fund and paying out a distribution. Well, they weren't doing anything to generate income, so how were they doing it? But so he warned you. But title announcement here that they would be closing their Defiance leveraged long plus income style ETFs. They've got a handful of them on Palantir, Supermicrocomputers, Robinhood, Ethereum, Advanced Micro Devices, and Hims and Hers, as well as two others, the $1 Trillion Club Index ETF and their daily 2 times short of Eli Lilly Company. All right, so what, and it says, let's see, just so you don't panic if you have these, the final day of trading for the funds on the NASDAQ will be Monday, January 26th. So you got next Monday coming up. If you're watching the video today, it's 4 days away. After the market closes on this date, the funds will be delisted and no longer accept creation orders. All right, so people trying to buy in would only be able to buy if people who own the shares are willing to sell. The title themselves will not be able to issue creation orders to fill that demand if there is any. Now, shareholders who continue to hold the shares as of each fund's liquidation date, which is Friday the 30th, so the end of next trading week, will have their shares automatically redeemed for cash at the fund's net asset value. So what they're saying, it doesn't really matter if everybody gets scared and sells out of these, because these ETFs are not like a stock where solely priced on supply and demand. And so if everyone's a seller and no one's a buyer, the price just keeps on tanking. These ETFs are, they have a net asset value, which is basically the sum value of all the holdings, the assets within the fund divided by the amount of shares. So if a stock's at $40 with a million shares and people get out of it, and now there's only a 500,000 shares left, it'll still be at $40 because they would have sold at $40, and it doesn't change the value. You would just now have half as much assets divided by half as many shares, which would still equal the same number. Hopefully that's making sense to you. But everybody's got different types of caution. Me personally, I do not own any of these. If I did, I would be selling prior to that. This is not financial advice. This is just what I would do because I don't want to sit around and wait for that automatic cash disbursement and hope the calculation works out right and hope there's no bugs or issues in the system. But so that is what they are on record saying about it. Now, right before we start, I'm now set up to look at each of these funds to see how they have performed and see if it makes sense for them to be closing, because not necessarily sure, just because they're stopping the SEC, the reviews on these triple and more leveraged funds, does it make sense to close these, or is it just based on their performance? So try and figure out what it is. But before we look at that, I wanted to look at Defiance's website. Click on news. Now you would think if they were closing, what do we say, 6, 7, 8, 9, 1, 2, 3, 4, 5, 6, 7, 8 different funds, that it would be in the news on their website. We wouldn't have to search for it somewhere else, but here we have it. Defiance's latest news, we've got just last week, or a week or so ago, December, end of December, November, no mention that they're closing these funds. So we had to find that out from outside websites. Okay, we're going to back up here. All right, so now we're going to look at the funds, just running through them in order from here. And so I'm not going to do like a deep dive on how each fund works. Let's see if we can, one time look at how they're set up. And then from there, we're just going to see how they've been doing. So Palantir, right, what makes it stand out? It's got leveraged exposure, delivering anywhere between 1.5 and 2 times the daily performance of Palantir. So this is not one of those triple leveraged funds we're talking about. And then it generates income through the use of selling of a credit call spread. Okay, so we see that style of ETF a lot. Not necessarily always on leveraged. Sometimes it's just selling calls. Other times call spreads. Some companies are selling puts. But in any case, let's take a look. So I've gone ahead and we're looking up total returns to see what your money would have done if you had been invested in them. All of these funds are very young. These just started mid to late last year, August or September of 2025. So they haven't been around for a long time. Not a ton of outstanding shares, not a whole lot of assets under management. So this could be unrelated closure. These closures may more just be because these aren't catching on. There's not a lot of money in them, so it's not necessarily worth the efforts for the trading. That's just me thinking out loud that they didn't give us any more information on why they're closing them. We'll see on some of them. It's going to make sense. Others, maybe not so much. So first off, PLT. If we put them into dividend channels drip returns calculator, it's going to give us total returns. They came out August 18th, 2025. We click as if we invested $10,000, and that $10,000 would currently be worth $9,728 if you reinvested the dividends, and $10,200 if you did not. So obviously, nothing you'd be bragging about, but at the same time, this isn't anything terrible whatsoever. You're pretty much a little bit above or a little bit below break even. So first one off the bat doesn't jump out at us. Next up is SMCC. All of these from Defiance, same strategy. All right, 150 to 200% or 1.5 to 2 times leverage, along with selling calls. Let's see, they've been out since same-ish time, August 19th. There's only $2.5 million in this one. And we'll take a look. We've already got all the information pre-plugged in here. And now that one's ugly. If you were reinvesting your dividends, you would actually be down more than 50%, down 51.24%. That's real ugly, especially in a short amount of time as from August to January. If you had kept your distributions and not reinvested, you'd be doing a little better. Your $10,000 would be worth $6,000. You'd still be down nearly 40%. So SMCC not doing well. That one makes a little more sense. Next up is HOOI, HOOI. Same strategy once again, but on Robinhood. We'll scroll down, take a look. Less than $2 million in assets under management. And August 18th starting date. We're pre-plugged in here. And down about 25% if you were reinvesting, and down about 13, almost 14% if you were not. So it seems like what happened is they went up quickly, and so then your reinvesting at a high price would have hurt more as the share price came back down. So again, not great, not wonderful. This one's not absolutely horrible, but it's definitely worse than PLT. So HOOI, maybe. Next up, ETHI. It's their Ethereum version of this strategy. It came out in September, so a month later than all of those. It's been around even shorter time. It does have a little more money in it, $4.8 million. If we see how your money would have done if you invested starting when they came out, that's ugly. You're down. 10,000 is now worth anywhere from 4,200 to 3,800. You're down 57 to 61%, and that's not annual. That's just currently in that short couple of months. That comes out to an annualized gain of a negative 180%. So it's basically saying, obviously, you're going to head to zero pretty quick within less than a year. So ETHI, which is odd, has the most money invested in it so far out of the ones we've looked at, is actually doing the worst. Next up is AMDU. Same strategy once again on advanced micro devices. They came out August 19th, similar to the first handful of single tickers. There's 5.6 million, so another one that's, not all the way down there at the bottom. It's bigger than most. Let's see how they've been doing since they came out, and they're doing great, absolutely great. If you bought them back in August when they came out and left it on dividend reinvest, you would be up 68.5% so far just in that short time frame, which would come out to an annualized yield of 162%. So I bet you there are some people invested in AMDU that are not happy that this fund is going away, closing at the end of this month. I sure would be if I was up that big. So not sure why this one's closing out. Has a decent amount of money invested in it and is performing better than anyone could ever ask for. Next up is HIMY, HIMY. Once again, same strategy, but this time on hims and hers. Came out August 18th, $2.7 million invested in it. If you bought in at the beginning, you're not doing well. Down 58% if you were reinvesting and 40% if you were not. Your 10,000 turning into anywhere from 4,100 to just under 6,000 annualized yield. If you're reinvesting, you're going broke in less than a year, and you're pretty much there. 94% loss over the course of a year if you were keeping your distribution. So HIMY's another one that definitely makes sense. It's to be on the cutting block. Next, we're changing up the strategy. This is not that leveraged plus income. This is just an ETF that collects the $1 trillion members. So underlyings that have $1 trillion or more in, I don't know if it's market cap or assets under, it'd be market cap. So you're looking at NVIDIA, Tesla, Microsoft, Apple, Alphabet, Amazon, Meta Platforms, Broadcom, Berkshire Hathaway, and iBit. And so this one's a little different, right? They don't talk about leverage. They don't talk about income. There is a mention of distributions down lower on their page, but it shows as nothing. So they had a record date of December 29th, declaration December 26th, payable on December 30th, but they don't show any amount that they paid out. And so it's tough if you're not, and it's all swaps. So there you go. So it's not actual technical just holding of the shares, it's swaps instead. And so I'm not going to go into swaps, but you can Google it to look at that. And it seems like this one is more of just a failure to launch. Only 50,000 outstanding shares. They came out September 29th, and there's less than $1 million invested in it. So let's see if you bought in back in September 29th, how your 10,000's doing. Nothing major, down just about 3%. So they haven't paid distribution, so there's not two charts to compare to each other. So this one seems to be more of, like I said, failure to launch. It just seems like the investing world's not showing interest in it, and so it doesn't make sense for them to keep it open because they got to pay people to manage it. And then finally, last one, LLYZ. So this one's does include leverage, but it's going to be in the opposite side. They are shorting Eli Lilly. So let's see. Well, let's take a look at something real quick. They came out September of last year, September 2nd. Let's see what they're doing. Going after 2 times leverage and shorting it. So they are taking the negative approach to LLY. Let's just see how LLY has been doing. Yeah, so for the last 3 months, they have been shorting a double leveraged version of LLY, and in that time period, they're up 33.5%. So I'm going to imagine they're not doing real well. Let's take a look. Yeah, so if you put your money into them when they started, your 10,000 would now be 4,100. You'd be down 58%, and that's an annualized loss of 151%, meaning you're going broke before the year's end. So some of these make sense, some do not, like AMDU. I'm sure people are not happy about that one, but I just wanted to get that information out there, kind of look at it. So can't guarantee that at the start of the video, the SEC warnings are related to this. It's possible because these are talking about leverage, and some are doing very poorly. But I think the bigger picture is you're not going to see new ones coming out, and we may see some other companies closing up shop on some, especially if they get put too much pressure on them. So let me know what you think. If you can think of other funds you think are in danger, put them down there in the comments. But if you don't already follow the channel, please like the video, subscribe, share it, so people, especially if you know people that are into these Defiance funds, let them know that these closures are coming, so they are not caught off guard. But you could also follow me on X at ETFinspector.com. Let's see. Usually I tell a joke at the end of the video, so I'll throw a joke in there. This doesn't really seem like a joking matter, but we'll try to lighten it up a little bit. I just flipped the calendar, so if it's not funny, don't get mad at me. Joke of the day, I was trying to figure out why my basketball kept getting bigger and bigger, and then it hit me. All right, thanks for watching. Catch you in the next video. Have a good day.